Let's talk a bit more about the market and bring in someone who knows more than the three of us on everything happening these days. That's Lori Heinel. She's the Global Chief Investment Officer over at State Street Global Advisors. Lori, thanks for joining the show this morning. I'd love to just get your thoughts on the market now and what conversations are like that you guys are having with your clients, because we hear from so many folks in a similar seat as you that everyone's talking about retail, about Bitcoin, about this and that. Where are your clients at these days?
Well, thank you for having me today. And I really compliment the discussion you were just having. And those are the challenges that all of our clients are asking about too. Markets are at highs. Can they go higher from here? And our view is that they actually can. And part of that is the enthusiasm around the reopening and the pandemic, maybe not ending, but certainly having lockdowns go away to the degree that they had been in the past. But also it's fundamentals. I mean, we continue to see earnings being pretty strong in here. We continue to see policy support, whether it be monetary policy support from the Fed and keeping interest rates low, or whether it be fiscal policy support and helping to replace lost income. So unlike past recessions, we just don't think that you had that extended kind of drawdown, because there was the capacity for consumers to save and to continue to support their spending patterns. So we actually think that we're set up for a reasonably good 2021 and maybe even into 2022.
So let's talk positioning then, if we can, Lori, because, even if, we get this rally continuing overall in the market, are there certain areas of the market that you think are less likely to benefit from that? Or do you think we're going to have the kind of rally we've had, pre-pandemic, where kind of everything got swept up in it?
Well, there are a couple of ways to think about that. I think first and foremost, we're pretty bearish on bonds, because pretty much anything that speaks of reflation, reopening, economic recovery is actually quite negative in the aggregate for bonds. And when you couple that with a lot of public spending, that becomes also a bit of a challenge. So we actually think over the short term, the place to be most cautious is in fixed income. On the other hand, in equities, surely not everything is going to be lifted the same way. We continue to like elements that are geared towards consumer, so consumer discretionary. We continue to like technology and information services where you have more transparency to forward earnings possibilities. But increasingly, we're starting to like some of those unloved sectors and even some of the areas like value-oriented securities that have been so beaten down for so long. And the spread in the market has become much more important. So seeing participation from small caps, seeing participation from emerging markets. So we do think that there's a lot more breadth, but yes, we still want to be a bit more selective and find those places where it's a bit more defensive if things do go a bit more south again.
Laura, I want to just ask about the broad economic backdrop as well. And you mentioned the role that yields are playing here. And we're seeing, another morning where we're backing up, certainly at the longer end of the curve. But going from 1% to 5% on a GDP outlook, pretty marked move. Do you guys still feel like there's maybe risks to the upside here, that we're still stuck at home? It's snowing outside. It's kind of a bummer right now, frankly, but July will come and maybe we're even still underestimating just how much pent up energy there is for people to get out and engage economically.
Yeah, that's a good point. And I would say we were more positive in the depths of the worst days in March and April. We actually thought that it was going to be a very severe, but a relatively short, sharp contraction. And part of that was because of the stimulus that we saw and the ability for replacement income for unemployed workers and things of that nature. Conversely, we're probably a little bit less optimistic than the average right now, but it's more because we see this being a bit more elongated recovery. So we do think that we're going to see about 5% in the US GDP this year, but that's actually a little bit below consensus right now. And we think that this will extend out into 2022. And part of that, as you say, is that while there's a lot of enthusiasm around the vaccination rollout, it still is likely to be quite bumpy and take longer than what everybody thought back in December.
Even if you look at the underlying economics as positive and what we're seeing in the market as positive, there is a feeling, and I know, Myles was just talking about not building your whole basis on behavioral economics, but that's got to be a factor. There is this sense right now of make hay while the sun shines. Like, look at Bitcoin, look at SPACs, look at all of these areas of the market. Let's take advantage of it while it's happening. Are you seeing that risk appetite really ratchet up among your clients? And is there a risk in that, that if there is a bump in the road, that it's going to then sort of have a ripple effect?
Well, there seems to be a pretty big demarcation between kind of classic institutional investing, where you're taking more diversified bets, you're buying broader market type instruments, whether it be indexes or active strategies that follow indexes, versus this sort of other sidebar conversation around individual securities, Bitcoin, Tesla, things of that nature. In general, we think that the fundamentals underpinning the broad market are actually quite strong. That, as I mentioned before, there's good monetary policy support, there's good fiscal policy support. We're starting to see earnings come through. So for investors that are taking a kind of broader picture view and investing in a more classic way, we don't think that the risks are quite so high. But as you note, chasing any particular investment, whether it be a stock or a crypto or some other things, that's going to have a lot of volatility, and there are going to be significant winners and losers. That's still not the major thing that's driving markets, though.
All right, Lori Heinel with State Street Global Markets. Lori, great to get your thoughts this morning. Thanks so much for joining the program. We'll talk soon.
Thank you.